welcome to the Property Academy podcast. I'm your host, Ian McKnight. And today's show, we are talking about the Reserve Bank's most recent OCR announcement and update. So we're going to talk to you all about where interest rates are heading, and we are going to dissect that press conference so that you can hear it from the horse's mouth. You can hear what the economists and the governor of the Reserve Bank are saying, what they really said, and then we're going to interpret it. First of all, of course, the OCR did increase. What did it increase to? 0.5%, which is actually quite a big increase. Biggest increase in how many years?
A long time.
30-something years, I think. Up to 2%. So, no, that was the last OCR increase.
Was it?
Yeah, it's because there was a 0.5% increase before.
Okay.
Last time.
Okay.
6 weeks ago.
Close enough.
Yeah. So let's go into what this all means. First of all, it was very exciting. A new, what they call OCR track was released. And for all of you guys watching on YouTube, you can see this. For you guys listening on the podcast version, hey, I'm going to explain it to you. So they release what we call the OCR track. And this is what they think the OCR will be in the future. You can see the blue line here. It's going up, and in about 2024, previously they said it'll max out at about 3.3%. Now, they're saying, oh, no. Based on today's modelling, they think it'll peak at just under 4% in September 2023. So the main takeaway here is look at these two lines. One of them's gone up. So their forecast in May is that they are going to raise the OCR further and faster than they previously expected. Now, what that means is that we are going to expect to see quite a few more large jumps like this. And we'll talk about the reasons why later on the show. But really important to note, we have seen quite a substantial increase in that OCR track, the forward guidance of where they think the OCR will be in future. Now, the big question is, what does this specific move mean for interest rates? And the really interesting thing is, according to the Reserve Bank, as we'll hear in a moment, most of the increase that we've seen in this round has already been priced in. So before they made the announcement, the banks already were factoring this in to their interest rates. Let's hear it from the Reserve Bank Governor.
Financial conditions as a whole are now at least neutral, if not tightening. Why do I say that? Because the actual interest rates that people receive are significantly above the official cash rate. What are we doing today? We are just confirming where market pricing had already got to. And I think that's an important thing that people need to remember, is that market pricing, not necessarily bank economists, but market pricing was largely where we have said we are today. So whilst it may surprise some commentators, it wouldn't be surprising the pricing in that sense.
So in that case, what's he saying, Andrew?
So the interest rate that you're going to pay from the bank today is probably already factored in the increase, the OCR increase that we saw with this change.
100%. So this specific change shouldn't have any increase on interest rates. Their forward guidance could have an impact on interest rates. Now, what are we thinking in terms of where interest rates are going to go? What are our current projections?
So if we look into Tony Alexander's crystal ball, our second favourite economist, the 1 year fixed rate this year, 4.49. By next year, he's thinking it's going to be up 1.25% roughly at 5.75. By 2024, you're going to start to see it drop back a bit, down to 5%. That's down 75 points. And then by 2025, he's thinking 4.25, and by 2026, back down to 4%. So what goes up must come down. So he's thinking kind of a sharp increase and then a downward turn after that.
And I think it's worth pointing out that it's not just Tony suggesting that at some point in the not too distant future, interest rates should start coming back down again. In fact, this was pointed out in the Reserve Bank Governor's initial speech, where he was saying we're going to raise interest rates while we have a significant inflation problem. At some point, we'll bring them back. Let's hear it from the Reserve Bank Governor, Adrian Orr.
I would like to say that once aggregate supply and demand are more in balance, then the official cash rate can return to a lower, more neutral level.
So they're going to take it up, fight inflation. Once inflation expectations start to become anchored, we expect that that OCR can come back down. One other important thing that they raised, which was he was saying, don't look at where we are right now when you're making your decisions, when you're thinking about where you think inflation will be in the future. Look at where we're telling you we're going. We're going to take interest rates up. We're going to bring them back down. Inflation is very high at the moment. We're going to bring it back down. And that's what we all need to keep in mind as we're making our decisions. But walk us through. He gave us some clues there, Andrew, about why the OCR is being raised, but what are the actual reasons?
So obviously the main reason is inflation, and that's caused by a couple of things. So at the moment, there's still huge demand in the economy here in New Zealand. It is still running it pretty hot. And remember, we've got a major supply issue. So the big factor in this is the labour shortage. So right now, people are able to leave New Zealand, but we're not getting that same number of people back in. So if we've got a labour shortage, all of this feeds into a inflationary pressure, which of course needs to be combated with the official cash rate increase.
So demand is high, supply is tight, so we are going to get inflation from that, and that is what they're trying to tackle. They're trying to bring back demand so it's more in line with supply. And actually, one thing that nobody could have predicted that happened at this press conference is a change in what they call their least regrets policy. I'm going to let you hear it from the Reserve Bank Governor in a minute. But the approach the Reserve Bank tends to take is they say, what is the worst thing that we're trying to avoid? Now, in the past, they were trying to support the economy through COVID, and their approach was we would rather avoid doing too little too late. We don't want to take too much of a timid action in order to support the economy. We want to give it as much noise as we possibly can to get through the COVID pandemic. Now, that is the reason why they cut the OCR by 0.75% back in early 2020. They have changed their least regrets policy now. I want to play it for you, and then we'll explain exactly what it means.
I've always talked about least regrets. The future's uncertain. What can we do? At least try to steer away from the worst possible outcomes. For us at the moment, that least regrets would be to have done too little too late. And at that point, inflation expectations are just continuously rising, and the task of putting inflation back to within its range becomes incredibly costly. So that's why we have erred to, risking doing too much too soon rather than risking doing too little too late. I use the word least regrets. There's a regret at both of those ends, but it's around what would you most prefer to avoid.
So what he's saying there is in the past, we were willing to risk doing too much too soon in regards to lowering interest rates. Now it's the other way. They're saying we're going to risk doing too much too soon with raising interest rates because we really are going to tackle this.
So they're taking a major sledgehammer approach to fixing the issue in the hopes that, if they go too far, it's okay, we can come back and correct it later.
And that's why we see such a change in the OCR track that we just looked at, because they are taking quite a large change in their approach to interest rate settings. Now, let's talk about what this all means for house prices, because there is a new forecast which has come out. So you see with the blue line here, for all you guys watching on YouTube, they were projecting a dip of about 8.9% from the peak to the bottom of the trough. In the May forecast, now they're saying just over 11%. So a couple of percentage points, just over 2% difference between the previous forecast and the current forecast. Now, bear in mind, that's probably an extra, 6 percentage points drop, because we've already had about a 6% drop from that peak in November through to the latest figures in May.
I encourage you to read the document. It's all in there on the page. I can't tell you exactly the date.
And can I just stress that there's a lot of uncertainty around these forecasts, and particularly around an asset price. So we're not pretending that we have a crystal ball.
So from that, it sounds like only Tony Alexander's got his crystal ball out there. But, ultimately, these forecasts will be proved wrong. Nobody knows exactly what it's going to be. But there is a worsening compared to what it was, to what their forecasts were in the prior quarter.
And just one thing, do you want to just bring up that graph there again? I just want to show, just one thing I want to point out. When you look at a downturn like this, see how drastic it looks when you look at this based on today's figures. But then when you go back to 2007, 2008, that adjustment in the market downwards doesn't seem quite as painful. Why is that, Ed?
Well, it's because as prices increase over time, prior dips appear to become less and less severe, because it's just like compounding interest. We see increases on increases.
Yeah, so when you're looking at this, don't look at this and think this is the worst drop we've ever had.
And one other thing I want to play for you is the Reserve Bank Governor talking about putting this into context.
The type of decline we're looking at is very mild and benign relative to where they have come from. Even a much more significant fall in that still has the level of house prices above where they were pre-pandemic. So a bit of perspective and a scale, I would suggest potential buyers apply to their thinking.
And one last thing that I just want to emphasise with this specific change is that the New Zealand economy is in a really good place to handle this change, at least according to the Reserve Bank economists. I'm about to play for you a clip where you're going to hear Paul Conway, the chief economist, quite recently in the job, but the new chief economist from the Reserve Bank talking about New Zealand's wherewithal.
Balance sheets, household balance sheets it's still in reasonably in good shape. The labour market is incredibly strong. The banking sector is very well capitalised. So the New Zealand economy is absolutely capable of coping with this rate increase.
And what I hope by playing you these clips and, taking out the best bits of the press conference, because let's be honest, not many people are actually going to watch this, but if we can put it into context for you and let you know what they're really saying and explain it a bit, then we can understand why the OCR is changing and where it's going to go in the future. Because otherwise, if you're not listening to this sort of stuff, there's a real risk you just see the headlines coming through and boy, does it sound scary. But when we understand what are they trying to do, where are they going to go, what could impact that? Hey, you know what? There could be another economic shock, which means they have to bring down interest rates. For instance, nobody thought that COVID would come along. Nobody thought that would see such high demand and such constrained supply. There will be some other event that could change this whole track. But if we understand where are they going? What are they doing? Why are they making their decisions? It can help us feel more confident when we make our property investment decisions. Let's wrap it up there, but please don't forget to rate, review, and subscribe to the Property Academy podcast. Really does help us get the message out to more people. And hey, if you want to build a property investment plan to achieve your financial goals, then you might like to come in for a complimentary portfolio planning session. This is where you work with a financial advisor to put together that property plan. And you know what? Easy way to sign up for this. Whip out your phone, send us a text. Our number is 5522. If you send the word plan to that number, we'll be in touch, see if it's the right fit for you. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight. And we're going to be back again tomorrow with even more daily strategies, tactics and insights to help you get the most out of the New Zealand property market. Until next time.